Welcome back. I'm Peter St. Onge. This is a weekly roundup of my daily videos on the economy and freedom, where I cut through the BS and lay out what the gaslighting clowns pulled out of their hats this week and what is coming next. China is now in a tariff war with America. Can it win? Last week, Donald Trump paused his worldwide tariffs, pulling them down to just 10% on everybody but China, who got a special rate of 125%, which they soon matched as expected. Trump exempted cell phones, computers, and semiconductors, which are about a third of Chinese imports, leaving the rest to hang. Now, this sets off an interesting dynamic where there's a big incentive to produce in America tariff-free, but also to move production from China to countries like Vietnam, Korea, Mexico, who enjoy an unbeatable tariff advantage over China. So now it's not just America, it's everybody against China. So who wins? The key point is U.S.-China trade is worth a lot more to them. So 3% of China's GDP is exports to the U.S. For perspective, 3% is about what farming makes up in the U.S., but our exports to China are barely over 0.5% of GDP, 1/6. That means in a tariff war, as Trump put it, quote, they run out of bullets first. Still, there are other ways China can fight. The four big ones are denying critical exports like rare earths, pressuring U.S. companies in China, devaluing their currency, and the big one, selling off China's mountain of U.S. treasuries to crash our bond markets. In short, every one of these creates more problems for Beijing than they solve, meaning China will run out of bullets first. So taking each, China can withhold critical exports, especially so-called rare earths used in electronics. Thing is, everything China exports is also made by other countries who do not face 125% tariffs. Even in rare earths, the number 2 producer is the United States. So we could fully replace China, bypassing environmental red tape, and in the meantime, we get rare earths from Australia or Thailand. Next, China can pressure U.S. companies with political harassment. The problem is China relies heavily on foreign investment, which already went negative before Trump, as companies fled to Vietnam or Mexico, so they would be shooting themselves in the foot. Number 3, China can devalue their currency, which they did last trade war to cancel tariffs. Alas, devaluing out of a 125% tariff would double China's energy and food import costs. Finally, the big one, China sells their hoard of nearly $1 trillion in treasuries and mortgage bonds. This would actually raise the Chinese yuan. They'd be selling dollars and buying yuan. Plus, they park that trillion not out of charity, but because the U.S. dollar is strong, liquid, and its bonds pay juicy interest. Moreover, if China wants to play hardball, Trump can play hardball. He can deny access to U.S. capital markets for Chinese companies, which cuts off trillions in cheap capital, or he could literally seize China's treasuries. Each one has a serial number, and China actually has trillions in outstanding loans owed to the U.S. from the 1940s. So what's next? Last week, China's message was, we will fight to the end. This week, China is saying it wants, quote, dialogue and consultation. Life is easier for Trump with a trade deal with China that boosts U.S. exports and brings at least some production home. Life is certainly easier for China, who has a lot more to lose and few good cards to play. Will Donald Trump's tariff wars crash the U.S. dollar? Is that a problem? Since Trump's worldwide tariffs kicked off 2 weeks ago, the U.S. dollar has lost nearly 4% of its value, with the dollar index dropping to 99.8. While that is a big move in 2 weeks, for perspective, the dollar hit 90 during COVID. Before COVID, it spent 5 years hovering around 97, so it is pretty much returning to normal. Still, the big move was surprising to financial markets since tariffs are supposed to make your currency stronger. You have fewer dollars going out for Chinese toasters. So what is hitting the dollar? A new piece by noted currency strategist Stephen Jen argues what's happening is that foreigners own so many U.S. assets that unlike normal financial shocks, which boost the dollar as a safe haven, in this shock, the mass sales are overwhelming the safe haven moves. I mentioned last week how foreigners own 26 trillion more of U.S. assets than we own of them. So when everybody sells, that's an extra 26 trillion of dollar-denominated assets getting dumped. Meanwhile, Jen thinks the dollar is actually starting from a massive overvaluation during COVID, 19%, he says, largely because of our trade deficit, as in because the rest of the world exports so much to the U.S., a big part of their banking system and company holdings are parked in dollars, meaning that if Trump is really unwinding the globalized export machine, it could permanently slash trillions in dollar demand overseas. Put them together and foreigners are dumping dollars in fear and then holding off in case they won't be needing so many dollars in the future. Now, this hurts if you own stocks, but the bigger concern is banks, because foreigners own roughly $12 trillion in American bonds, about two-thirds in U.S. treasuries, and the rest in corporate bonds or mortgage-backed securities. The problem is, if foreigners are dumping bonds, it drives bond prices down, which is already happening. That drives up the cost of capital to businesses, it's harder to borrow, drives up federal interest expense, and it drives up nearly every interest rate from mortgage rates to credit cards. Most important, the vast majority of American bank assets in America are in bonds, specifically treasuries, meaning crashing bonds could set off a bank crisis. Now, this is exactly what happened in March of 2023, when Silicon Valley Bank, First Republic, then a parade of smaller banks went under because their bond portfolios got wrecked by Fed hikes, as in their bonds fell below what the banks owe in deposits, which in banking is game over. So what's next? During the campaign, Trump repeatedly criticized a strong dollar because it cripples exports. Whether the falling dollar is an accident or intentional policy, this bodes well for gold, bodes well for Bitcoin, and it is a big red flag for American stocks and bonds. A word from our lead sponsor: the loudest voices in crypto, finance, and economics do not understand money. Join Parker Lewis and Dhruv Bansal of Unchained for Bitcoin Not Crypto, a 3-part masterclass that lays out why 21 million is the key breakthrough, and how Bitcoin, not blockchains, creates decentralization, and why everything else will be built on Bitcoin. Understand why Bitcoin works and why nothing else does. Register free at unchained.com/Peter to learn more. If you own gold or silver, you know they're a great hedge against financial instability and let you grow your wealth outside the banking system and gain greater control over your finances. Monetary Metals offers you the ability to increase your precious metal ounces every single month. Instead of paying to own metal, with Monetary Metals, you get paid 4% on your gold paid in more ounces. Now's the time to secure your wealth and build your legacy in an asset that the government cannot inflate away. Join thousands of investors earning interest in physical gold and silver every month with Monetary Metals. Visit monetarymetals.com/Peter to learn more. Now back to our show. Is Congress scheming to throw away every last penny of waste and fraud that DOGE finds? Last week, Trump had a cabinet meeting where they went around the table outlining their progress. What did you do this week with a bigger table? When it was Elon's turn, he announced anticipated savings of $150 billion in fiscal 26, which would be Trump's first budget. Left-wing media had a field day crowing how Elon's original $1 to $2 trillion in savings has now shrunk to just $150. Now, even allowing that Elon's $150 could be a minimum, the tea leaves are ominous in Washington. House Speaker Johnson, who is a Republican who should in theory like spending cuts, is now talking, quote, $1.5 trillion over a decade, as in $150 per year. Meanwhile, the House Freedom Caucus, which actually does like spending cuts, is in a civil war trying to block a budget resolution that contains just $4 billion in cuts, paired with a $4 trillion increase in the debt limit. What's happening, of course, is Congress's immune system is kicking in, attacking spending cuts like a foreign invader. And keep in mind, this is pretty much the dream team for spending cuts. We've got the allegedly small government GOP holding both houses of Congress. We've got Elon and his team of big balls, and we've got a president doing his best to fire hundreds of thousands of federal workers and wipe out entire agencies. So why is it so hard to cut spending, and will it take fundamental structural changes to actually cut government? The root cause, of course, is paper money, which allows Congress to spend whatever its dark heart desires. Before the Federal Reserve, we were actually running surpluses, going from a national debt of 2.2% of GDP in 1890 to just 1.9% in 1910. No big balls required. World War I took it to 20%. Then FDR used the Federal Reserve to end the gold-backed dollar in order to fund his New Deal that took the country halfway to communism. This drove the national debt to 40% of GDP before the Second World War. The final blow was Nixon, who completely broke the link between dollar and gold in 1971, handing us permanent deficits, with debt hitting 56% of GDP by 1990, 92% by 2010, and now roughly 124% of GDP. The deficits, of course, drove big government, so federal spending went from 2% of GDP pre-Fed to 9.4% in the New Deal to 24% last year. So what is the solution? End the money printers by backing the dollar with something hard, whether it's gold or Bitcoin. So about 1.5% of all gold in existence is mined per year. In other words, it has supply inflation of 1.5%. For Bitcoin, it's even lower, 0.8% per year, compared to 7% for the dollar. Hard money means Congress cannot use the Fed to print unlimited money to spend, and we know from history exactly what that does. It returns us to the pre-Fed era, when government actually ran surpluses, even with a corrupt Congress. So what's next? Cutting off the money printer shrinks the predatory state, protects our freedoms, protects your life savings, and it ends the inflation recession cycle. Inflation is now nearly zero under Donald Trump, down from 5.7% annualized in Joe Biden's final inflation report. It's one heck of a move in 2 months. What is driving it? So last month, the Bureau of Labor Statistics dropped new inflation numbers for the month of March, as in before the tariffs. This was Trump's second inflation report card, and it was even better than the first. Overall, inflation actually dropped on the month thanks to crashing energy prices, and even core inflation, which excludes energy, came in at an annualized rate of just 0.7%. That brought year-on-year inflation down to 2.4 from 2.8 the previous month, and it brings Trump's average inflation rate to 1% even, compared to Biden's final number of 5.7. Meanwhile, new producer prices also came in, these measures what companies pay, at a 4-year low, also with a monthly decline and a 0.7 annualized on core. Now that's down from 20% annualized in Biden's final number. Rarely has inflation dropped so hard so fast, so what did it? Energy was the star, dropping 2.5% on the month. That's a 1/4 drop annualized. Gasoline actually dropped over 6% in a single month. There were some other drops in medical, pharmaceuticals, and travel, along with a pleasing drop in used car prices. I've been using those as a proxy for self-deportation since departing illegals flood the used car market, and they dropped about 0.7% on the month, which is about 9% annualized, a decent clip. The rest of it was a mixed bag, flat for shelter, houses and rent. Prices fell for fruits, vegetables, and bread, but rose for meat and eggs. This was before Trump brought down egg prices with one cool trick of stop killing chickens, so it was mainly energy. Now that's a combination of increased production here and overseas, along with slowing economic growth in China even before the tariffs. I mentioned in recent videos how China's economy has been in trouble from overcapacity and mountains of bad debt, which is part of why Trump's trade war is hitting them so hard. So what's next? March was the last inflation number before Trump's big tariffs. Even after he trimmed most of the tariffs to 10%, China is still facing a 125% tariff wall. So in the near term, this will hit everything where Chinese imports are a big share. Trump exempted cell phones, computers, and semiconductors, which are about a third of Chinese imports. But that leaves clothes and toys, furniture and household goods, construction materials, tools, manufacturing inputs from chemicals to batteries. These come to about $350 billion, possibly $500 billion once you include re-exports of Chinese goods through Vietnam and Mexico. So that would in theory be a point or two one-time hit to inflation. But of course, if Chinese socks or electric drills are twice the price of India, the inflation's a lot lower. Importers just change countries. That means that near term, tariffs are probably a couple tenths of % on inflation. How long depends how fast importers can switch to other countries, how much inventory they have in the meantime, and how quickly domestic replacement can stand up new factories when and if the tariff dust settles. That all brings us back to what is fundamentally driving both inflation and reindustrialization: federal spending, the red tape and taxes that come along for the ride. If Trump and Congress can fix that, inflation will stay low even with jumbo tariffs, while Americans can start making stuff again. A word from our sponsor: one of the best ways to secure your Bitcoin is with a hardware wallet, a physical device that lets you keep your coins offline without internet connection. One of the most trusted names in hardware wallets is CoinKite, maker of the famous block clock. CoinKite devices are made in Canada. They're run by passionate Bitcoiners who've been at this since 2012, back when Bitcoiners were trading in person at swap meets. You can pick up hardware wallets and plenty of other goodies at coinkite.com/ProfSaintAnge. That's CoinKite.com/ProfSaintAnge. In crypto, we read about new hacks every week with top coins spiraling into oblivion. Except for Bitcoin. It has never been hacked. The enormous innovations going into crypto will ultimately migrate to the gold standard of Bitcoin. Trammell Venture Partners is a Bitcoin-native venture capital firm that's been around since the beginning back in 2009. They back some of the top brands in the industry, including Kraken and Unchained. Check out the third annual report on Bitcoin-native startups, tracking nearly $1.2 billion in early-stage Bitcoin-native software startups. Visit tvp.fund. Now back to our show. American manufacturing jobs are coming home with green shoots sprouting even before Trump's big tariffs. Will America's Rust Belt be replaced by charming downtowns with quirky antique shops? Lost in the tariff chaos these past couple weeks were two key job reports that came out showing a boom in jobs under Trump. So on April 4th, the Bureau of Labor Statistics released monthly numbers saying 228,000 jobs were created in March. That's up 70,000 on the previous month. Even better, the ADP employment report, which excludes government workers, said the economy added 155,000 private jobs in March. That was almost double the previous month's tally of 84,000. What was most interesting in ADP was manufacturing jobs, which jumped for the first time in 2 years. This puts manufacturing job gains since Trump took office around 35,000 over 2 months. It is not world-changing, but that's compared to 150,000 manufacturing jobs lost in the last 2 years of Joe Biden. So green shoots matter because Trump just set off a race against time with tariffs, with domestic manufacturing getting hit for lack of cheap Chinese components or even supply chain shocks, even as tariffs themselves encourage domestic production. The problem is in the near term, you lose faster than you create for the simple reason that it takes years to start new factories. You gotta line up the money, choose the location, build the factory with environmental permits, hire hundreds of people, work out the suppliers, distribution to get it on the shelf at Walmart. Indeed, we saw this in horrible survey data in manufacturing this week from the Philly Fed, as well as weak industrial output numbers. So with tariffs, it gets worse before it gets better. Now, some manufacturing can be set up faster than others, so textiles like clothes and bed sheets, MyPillows, they can be done in about a year. Electronics assembly or food processing might take closer to 2 years. Car parts or chemicals might take 3. And pharmaceuticals or aerospace can take 4 years or longer, which is more than Trump has. Granted, you could go faster. Elon set up his Austin Gigafactory in just 13 months. Still, most companies are not Elon. This means that tariffs cannot immediately reindustrialize. Physics does not permit it, nor do HR departments and Walmart buying agents. At best, you get expansion of existing American factories, which can only handle so many products. They don't have the machines, the talent, or the distribution to, say, change from drill bits to stuffed animals. So what's next? Reindustrialization will be a long process, and it won't even begin until 3 things happen. Stability in tariffs. You don't build factories if Trump's going to change his mind tomorrow. Number 2 is cutting red tape, especially environmental rules on manufacturing that can add tens of thousands in cost per worker. And number 3, cutting taxes, fees, and permits on manufacturing, especially small outfits, to help them get off the ground. Trump and Elon are doing their best on every front, cutting useless rules and trying to lower government spending, while Congress, of course, is dragging its feet. Until that changes, we may not get much more than green shoots. If that happens, Americans are looking at paying tariffs for imported goods for a very long time. Thanks for tuning in. Remember to subscribe so you don't miss an episode, and go to petersaintange.com for daily videos and in-depth articles with charts and all the gory details. Okay, we'll be watching. See you next time.